Hey everyone, welcome back to Corporate Decoder, the place where we dive into financial filings to uncover the real story behind the numbers. And today we're going to be looking at the Federal Home Loan Bank of Chicago's latest report. And let me tell you, it's all about the money they're borrowing to keep things afloat, so buckle up. Before we dive in, if you appreciate getting straight insights from corporate documents like this, make sure you're subscribed. We really appreciate it, and if you want to chat more about these details and connect with other finance enthusiasts, our Discord community is linked in the description below. Come on over. So what is this report all about? Well, it's a Form 8K, a current report filed with the SEC. This usually means something significant has happened that investors need to know about right away. In this case, it's about the Federal Home Loan Bank of Chicago issuing debt, and that's a pretty big deal for understanding how they operate. The Federal Home Loan Bank of Chicago, also known as the bank, is essentially raising money by selling bonds and notes to the public. Think of it like this: they need funds to operate, and they get those funds by borrowing from investors. These aren't just any loans, though. They're called consolidated obligations, which means all 11 federal home loan banks are on the hook for them. This means if one bank struggles, the others have to cover its debts. This section directly addresses the creation of financial obligations. Essentially, the bank is taking on new debt. The report explains that they get most of their money from selling these debt securities in the capital markets. These are bonds and discount notes, and together they are the joint and several obligations of all 11 federal home loan banks. It's important to remember that these are not guaranteed by the United States government. Now, here's a little detail of how they report things. They can actually change how they tell us about these debt issuances at any time. This means we need to be a little careful when we look at their reports over time to make sure we're comparing apples to apples. They also mention that while issuing debt is important to them, they haven't specifically said if any single debt issuance is super important on its own. This is where things get interesting because it's the actual list of the debt being issued. Schedule A lists all the bonds and notes they've committed to issue. It specifically excludes short-term notes, usually those that mature in a year or less, because those are just part of their everyday business. It also includes any longer-term debt they've taken over from other banks. Let's look at the actual numbers. The report shows several issuances, all with the trade date of August 27, 2025. This means these debt agreements were made on that date. First up, we have a bond with a maturity date of September 10, 2027. That's a little over 2 years from now. The principal amount here is $15 million with a coupon rate of 4.25%, and it's described as non-callable, meaning they can't just pay it back early. Next, we see another issuance with a much longer maturity date, September 10, 2035. That's a 10-year note. The principal is $30 million and the coupon rate is 5.080%. This one is interesting because it has an optional principal redemption with an American call style. This means the bank can choose to pay back the principal at any time after a certain date until maturity. It's like having an early exit option for them. Now, this next one is a big one, a $1 billion issuance with a maturity date of February 26, 2026. That's less than a year away. The coupon rate is 3.75 and year away, the coupon rate is 3.75%. Notably, this is an optional principal redemption with a European call style, meaning they can only redeem it on a specific date. This is significant because a bond of this size maturing so soon could have a big impact on their short-term cash needs if they intend to refinance it. Then we have a $50 million bond maturing in September 2030 term. The coupon rate is 4.80%. This also has an optional principal redemption and an American call style. Here's another substantial issuance, $150 million maturing September 2038. That's a 13-year bond with a coupon of 5.450%. It's also an optional principal redemption with an American call style. And another long one, $40 million maturing September 2041. That's 16 years. This bond has a 5.625% coupon, and it's an optional principal redemption with an American call style too. Next up, $15 million with a maturity in August 2026. The coupon rate is 4.00000%. This is an optional principal redemption with a Bermudan call style. This means it can be redeemed on specified recurring dates on and after the first redemption date. Finally, we have two identical issuances of $25 million each maturing in August 2026 with a coupon rate of 4.30%. These are also optional principal redemptions with a Bermudan call style. If we add up the principal amounts on this schedule that aren't short-term, we're looking at over $1.3 billion in new debt being issued. This clearly shows the bank relies heavily on the market for funds, and these issuances are how they get it. Let's quickly clarify these call options. Optional principal redemption bonds, or callable bonds, as they're more commonly known, give the bank the power to pay back the debt early. This is usually done if interest rates fall, making it cheaper for them to borrow again. And the different call styles, like American, Bermudan, or European, tell us exactly when they can exercise that option. American means they can call it pretty much any time after a certain point. Bermudan means they have specific dates to choose from, and European means it's all or nothing on one particular date. After all the detailed tables and descriptions, we have the signatures. This part is basically a formal sign-off confirming that the report is accurate. Here, Michael Palumbo, a vice president of the Federal Home Loan Bank of Chicago, officially signs off on this report on September 3, 2025. Now, let's talk about what this all means. The Federal Home Loan Bank of Chicago is issuing over $1 billion in debt in a single day. This isn't unusual for banks, but it highlights their reliance on capital markets to fund their operations. The coupon rates ranging from about 3.75% to over 5.6% are what they're paying investors for these loans. Looking at the mix of maturities, we see some short-term debt maturing within a year and then longer-term debt stretching out for over a decade. The optional redemption features are important too. They give the bank flexibility, but also mean investors might get their money back sooner than expected if interest rates move. For the Federal Home Loan Bank of Chicago, its strength lies in its ability to access capital markets efficiently, and it seems to be doing that here. The variety of debt instruments with different maturities and call features shows a sophisticated approach to managing their funding needs. Their weakness potentially lies in the joint and several nature of these obligations, meaning if another federal home loan bank falters, they are all responsible. The key takeaway from this filing is the scale of their debt issuance. Simply put, they are borrowing a lot of money. The specific terms and interest rates give us a snapshot of the cost of that borrowing. It's a constant balancing act for them to get the funds they need at the best possible rates without taking on too much risk. So what's my take? The Federal Home Loan Bank of Chicago appears to be operating as expected by issuing debt to fund its activities. The numbers presented are substantial and reflect the scale of their operations. A notable risk is always the interconnectedness of the federal home loan banks. If one experiences distress, it affects all of them. An opportunity is their ability to manage interest rate risk through the various call features on their debt. Overall, this report confirms the Federal Home Loan Bank of Chicago's role as a significant borrower in the capital markets. It's a pretty standard operational report, but the sheer volume of debt issued is noteworthy. Alright, that's our breakdown of the Federal Home Loan Bank of Chicago's latest filing. What's your take on these numbers and what they signal for the bank's future? If you found this analysis valuable, hitting that like button truly helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description to continue the conversation. Thanks for watching. See you next time.